Well, the frenzy around AI-related stocks has caught a lot of Wall Street strategists off guard. So far this year, we've seen at least 5 big shops boost their 2024 forecasts for the S&P 500, which has already rallied roughly 7% this year after a 24% gain last year. In the past week alone, Piper Sandler, UBS, and Barclays have boosted their targets. And note 2 firms, Goldman Sachs and UBS, have done it twice since December. Now, you might recall last year, some of these same firms were also caught off guard. The difference is that in 2024, it seems strategists aren't waiting as long to revise their targets. Now, going back to last year, our next guest rarely wavered from his bullish view. Alec Young is chief investment strategist at MapSignals, and he joins us with his outlook from here. Alec, first of all, for those who are trying to make sense of what's going on right now, what has been going on in the stock market?
Hey, John, it's great to be with you. Well, I mean, we're getting a little bit of a melt up. The thing that has people worried is that we're up about 25% since late October, from 4,100 to about 5,100 on the S&P 500. So it's a historic move in such a short period of time. That has people instinctively wanting to hedge, take profits, raise cash. But what we're seeing at the same time is inflation continuing to fall, economic data better than expected, corporate earnings better than expected, and the market's realizing that while the Fed rate cuts may not come as soon as expected, the economy doesn't really need them, and corporate earnings don't really need them right away. We want to have them eventually, but if we have to wait until the summer instead of March, it's not the end of the world, because the fundamentals of the economy are just coming in better than expected. As you mentioned, a lot of these strategists coming into the year in December, the consensus was 4,800 on the S&P by the end of this year. So the reason that these firms are scrambling to raise their targets is because their targets were just way too low. I mean, the market's already 5% above the average target they had for the end of the year. So it's just the math is so compelling that they really have no choice other than to dig in their heels and stand by a very conservative target or to raise it.
And so for people who are trying to figure out how to be positioned in this environment going forward, what's your advice right now on the kinds of industry sectors to watch closely, to be constructive on?
Well, we think the main thing, especially for investors that have more than a 1 or 2 month time horizon, looking out to the end of the year, looking long term, which is how most investors think about stocks. They're investing for long-term goals like retirement. We would stay with this market. The biggest thing, the biggest risk is really getting spooked out of the market. Bull markets are born on despair, and we saw that in October of 22. People are very negative. They mature on skepticism, like what we're seeing now. They kind of mature further on acceptance, and eventually they die on euphoria. We're nowhere near that. The average bull market lasts 3.5, 4 years, 5 years. And when strategists are calling for the market to basically be flat for the year and scrambling to raise their targets, that's not a sign of euphoria. So while there might be appearance of euphoria in certain parts of the market, AI-related stocks, for example, that's a very narrow slice of the market. If you look at the broad U.S. stock market, there's a lot of very reasonable, non-euphoric signals out there, and a lot of professionals are very skeptical about the rally. These are just not the things that you see at the end of a bull market. So our advice would be, unless you're very short-term oriented, stay the course, tune out a lot of the cautious noise that you hear. I think stocks will find a way to continue to surprise the crowd by going higher and higher. It's a classic wall of worry situation where despite all the concerns that people bring up, the market continues to work its way higher through them.
I was talking to J.J. Kinahan yesterday, who said the litmus test of your taxi driver talking about stocks, that we're not quite there. Right. So maybe you can keep tabs on what's happening in your Uber. Speaking of Uber, you talked about technology, and you said you're committed to some of the trends that have been working. So technology is one group you're still relatively upbeat on, but also financials and healthcare. Walk us through the recipe.
Yeah, sure. So actually, financials and healthcare, a couple of laggards from last year, they're actually the top performing sectors outside of tech and communication services so far in 2024. They're starting to work. much cheaper valuations. And healthcare, you've got some pretty explosive earnings growth. There's a possibility of a Republican shift in political leadership in the U.S. Obviously, it's too soon to say with any conviction, but net, that would be a positive for a highly regulated group like healthcare, probably be a positive for financials as well. So that's a potential catalyst, later as we move through the year. But generally, we are quietly seeing a broadening. It's easy to miss because of all of the excitement around NVIDIA and a lot of the big tech stocks. But if you look more broadly throughout the S&P, I could rattle off 20 or 30 stocks that have nothing to do with technology that are making all-time highs. Things like Waste Management, McDonald's, JP Morgan Chase, the Ecolab, Zoetis. These are blue chip market leading stocks in each of their categories from a variety of sectors, healthcare, financials, industrials, making, really exciting new highs. So the market is starting to broaden out. Look beyond tech in 24. You want to own tech, but own other things too.
Alec, thank